The global impact of U.S. Federal Reserve decisions on interest rates. The U.S. Federal Reserve's decisions on interest rates are not only central to managing the American economy, but also have far-reaching effects across the globe. As the world's most influential central bank, the Fed's actions impact global financial markets, trade balances, and economic stability. When the Fed raises or lowers interest rates, it influences the strength of the U.S. dollar, global investment flows, borrowing costs, and the competitiveness of exports and imports. These ripple effects are felt acutely in emerging markets and by multinational corporations, which must adjust to the changing landscape. Furthermore, many foreign central banks adapt their own policies in response to the Fed's moves, sometimes out of necessity to maintain currency stability or to prevent capital outflows. Thus, the Fed's interest rate decisions are not isolated to the U.S., they are pivotal to the dynamics of the global economy, affecting growth, inflation, and financial stability worldwide. Number 7. Influence on global currency markets. When the Federal Reserve raises interest rates, it generally strengthens the U.S. dollar as investors are drawn to the high returns available on dollar-denominated assets. This stronger dollar has several notable effects on international trade and currency markets. First, it makes U.S. exports more expensive for foreign buyers, which can reduce demand for U.S. goods and widen trade deficits with other countries. Conversely, it lowers the relative cost of imports, benefiting U.S. consumers but potentially increasing trade imbalances as domestic companies face tougher competition from cheaper foreign goods. This shift in trade dynamics can strain other economies, especially export-reliant countries that struggle to compete with cheaper imports into the U.S. Furthermore, a robust dollar impacts countries with substantial dollar-denominated debt as their repayment costs rise in terms of local currency, making debt servicing more burdensome. This financial pressure can lead to inflation in these countries as the weaker currencies drive up import costs, particularly for essential goods priced in dollars like oil. Altogether, these dynamics introduce significant exchange rate volatility, which can destabilize economies dependent on the dollar and lead to inflationary pressures worldwide, particularly in emerging markets. Number 6. Impact on emerging markets. Rising U.S. interest rates can trigger significant capital outflows from emerging markets as investors, attracted by higher and safer returns in the U.S., withdraw their investments from these economies. This capital flight often leads to depreciation of emerging market currencies, which can reduce investor confidence, decrease stock market valuations, and increase local borrowing costs. For many emerging economies with substantial U.S.-denominated debt, a stronger dollar worsens these challenges. As the dollar appreciates, the cost of repaying or servicing U.S.-denominated debt rises, putting immense pressure on national budgets. This can divert funds away from essential services and investments in growth, potentially destabilizing economies and increasing the risk of debt crisis. Instances of these risks have been observed historically, as seen in Turkey and Argentina during previous Fed tightening cycles, where rising U.S. rates and a strong dollar exacerbated financial vulnerabilities and led to severe economic challenges. The combined effect of capital outflows and rising debt servicing costs underlines the financial fragility of emerging markets in response to U.S. monetary policy, often making them disproportionately vulnerable to Fed rate hikes. Number 5. Global financial stability. U.S. interest rates play a critical role in shaping global lending and investment patterns. When rates are low, U.S. investors often seek higher returns in foreign markets, leading to increased cross-border lending and investment flows that support economic growth in recipient countries. However, as U.S. rates rise, these capital flows tend to reverse, with investors pulling back into safer, higher-yielding U.S. assets. This sudden withdrawal of capital can destabilize economies that rely heavily on foreign investment, especially those with fragile financial structures or significant external debt, as it pressures their currencies and increases the cost of servicing dollar-denominated liabilities. Moreover, as the Fed tightens its policy, other central banks often feel compelled to follow suit to manage exchange rate stability and prevent excessive currency depreciation. This synchronization, while helpful in reducing currency volatility, can limit monetary policy autonomy, as central banks like the European Central Bank or Bank of Japan may raise rates or adjust policies in line with the Fed, even if domestic economic conditions do not warrant it. This can lead to suboptimal policy outcomes, where countries are forced to prioritize exchange rate stability over domestic growth or employment objectives, illustrating the challenging balance between global financial interconnectedness and national policy needs. Number 4. Trade and inflationary effects. A strengthening U.S. dollar can lead to imported inflation in countries that rely on U.S.-priced goods or commodities like oil, as these items become more expensive in local currency terms. Since commodities are often priced in dollars globally, any appreciation in the dollar directly translates to higher costs for importers, pushing up local inflation rates. This effect can be particularly pronounced in developing economies where a large portion of consumer goods and essential imports like fuel are dollar-denominated, making them vulnerable to inflation spikes when the dollar strengthens. Additionally, a stronger dollar impacts trade balances, offering advantages to countries that export to the U.S. as American consumers and businesses gain greater purchasing power to buy foreign goods. However, this also poses challenges for U.S. exports as American products become more expensive for foreign buyers, potentially reducing demand and widening the U.S. trade deficit. The broader effect on global supply chains is also significant. As U.S. demand shifts, supply chains reliant on U.S. consumers may face disruptions, affecting both production and employment in export-oriented economies. Together, these dynamics illustrate the complex ways in which currency fluctuations influenced by U.S. monetary policy can reshape inflationary pressures and trade flows across the global economy. Number 3. Effects on international financial markets. U.S. interest rate hikes can trigger widespread stock market fluctuations globally, as investors tend to move their capital from riskier assets, like equities, into safer fixed-income investments that become more attractive in a higher-rate environment. This shift can lead to declines in stock markets worldwide, especially as many international markets, particularly in Asia and Europe, have become highly sensitive to U.S. Federal Reserve rate announcements. The anticipation of U.S. rate hikes alone often prompts volatility, as investors adjust portfolios to manage risk. In the bond markets, higher U.S. interest rates drive up yields on U.S. bonds, drawing more investors toward these relatively higher-yielding assets. As capital flows into U.S. bonds, global bond yields also tend to rise as other countries are pressured to offer competitive returns to retain investment. This has a direct impact on the cost of borrowing and refinancing for other nations, particularly those with high debt levels or substantial financing needs, further tightening financial conditions and potentially slowing economic growth in countries around the world. These interconnected effects underscore the global reach of U.S. monetary policy and the complex dependencies among international financial markets. Number 2. Impacts on multinational corporations. Higher U.S. interest rates can significantly affect U.S. multinational companies operating internationally by raising their cost of capital. As borrowing becomes more expensive, companies may reduce investments in foreign markets or scale back international operations to manage costs, which can lead to cutbacks in employment and dampen economic growth in host countries. Additionally, companies with revenues across multiple currencies face increased challenges from exchange rate volatility, as a stronger dollar can reduce the value of foreign earnings when converted back to dollars. To address these fluctuations and inflationary pressures, companies often adjust pricing strategies in different regions, which may involve raising prices in markets with weaker currencies or higher inflation rates. However, such adjustments can pressure profit margins as demand may fall in response to higher prices, forcing firms to make further strategic adjustments, including realigning supply chains or shifting resources to more stable or profitable markets. These combined effects illustrate how U.S. rate hikes not only affect domestic conditions but also cascade through global operations, influencing economic stability and business strategy worldwide. Number 1. Potential for global recession. Aggressive rate hikes by the U.S. Federal Reserve can have ripple effects across the global economy, as higher U.S. interest rates generally strengthen the dollar, making dollar-denominated debt more expensive for other countries and increasing capital outflows from emerging markets. This can exacerbate vulnerabilities in lower-income, export-driven economies, where growth depends heavily on foreign investment and global demand, which tends to decline during periods of higher U.S. rates as global economic activity slows. For countries relying on exports, this slowdown can reduce demand for goods, thereby impacting jobs and local economic stability. Compounding the issues, central banks around the world must navigate these shifts alongside the Fed's policies, making coordination a critical but challenging task. The Fed's focus on U.S.-specific goals, like controlling domestic inflation and stabilizing employment, can unintentionally strain international markets, causing volatility and economic contraction elsewhere. Effective communication and some level of coordination with other central banks are essential to help mitigate these unintended global consequences. Yet achieving such alignment is complicated by diverse economic conditions and policy goals worldwide. Thanks for watching and subscribing channel.